This document provides an in-depth analysis of the cyber insurance market, which has seen significant growth and challenges in recent years. The National Association of Insurance Commissioners, NAIC, reported a 75% surge in cyber insurance premiums between 2020 and a recent period, indicating the market's response to escalating cyber threats and the rising demand for coverage. Despite this growth, the market is relatively new, with substantial traction gained within the last 5 to 7 years, and is currently grappling with issues such as the high demand surpassing supply willingness and unsuitable underwriting practices. A qualitative summary of the document is provided, ensuring that security professionals and specialists from various industries can understand the implications of the cyber insurance market's growth and the utility of the analysis for enhancing cybersecurity measures and risk management strategies. This document serves as a valuable resource for professionals in cybersecurity, devopsec, devops, IT, forensics, law enforcement, and other related fields, offering insights into the complexities and opportunities within the cyber insurance market. The current state of the market. S&P Global Ratings reported that global cyber insurance premiums reached about $12 billion in 2022 and projected an average annual increase of 25% to 30%, potentially reaching $23 billion by 2025. The growth of the cyber insurance market is heavily reliant on reinsurance protection, and reinsurers are considered crucial for its sustainable expansion. The industry is encouraged to foster more sustainable underlying growth that is not solely dependent on rate increases but also on addressing systemic cyber risks and expanding coverage to more small to mid-size enterprises. The current state of the cyber insurance market is showing signs of stabilization after a period of high pressure and premium increases. This market has been described as hard, with insurers facing challenges such as rising premiums and reduced flexibility in policy terms. However, recent trends indicate that the rate of premium increases is slowing down, and in some cases, policy renewals are occurring at flat rates. Despite this stabilization, the market is not expected to return to the softer conditions seen in previous years. Products are now covering less, with carriers imposing new restrictive policy wording. Strict underwriting control requirements that were mandated in the past will continue, and the demand for capacity is still outpacing supply. Additionally, there is a growing concern among cyber insurance markets regarding systemic cyber risk, which focuses on quantifying the impact of a potentially catastrophic cyber event. The cyber insurance market is relatively new, having gained significant traction within the last 5 to 7 years, and it is still working through various challenges. Insurers are developing stricter policy requirements, which has led to a decrease in the number of insurable companies and an increase in demand. However, there is optimism that insurers and vendors will collaborate to develop sustainable solutions, with a focus on improving risk management and risk quantification. Top cyber attacks. Cyber insurance policies typically cover a range of cyber attacks and incidents, including data breaches. These incidents involve unauthorized access to or theft of sensitive data. Cyber insurance can help cover the costs associated with responding to a data breach, such as notification costs, credit monitoring services, and legal fees. Network security incidents. This includes attacks that compromise the security of a company's network, such as malware infections, distributed denial of service, DDoS, attacks, and other hacking activities. Extortion. Cyber insurance often covers costs associated with cyber extortion, such as ransomware attacks where hackers demand payment to restore access to a company's digital assets. Data destruction. If a cyber attack results in the loss or destruction of data, cyber insurance can help cover the costs of data recovery. Business interruption. If a cyber attack disrupts a company's operations, cyber insurance can cover the loss of income during the downtime and the costs of restoring operations. Errors and omissions. This coverage applies to losses resulting from mistakes or negligence in the provision of services, which can include failures in cybersecurity services. Media liability. This covers claims related to digital content, such as allegations of copyright infringement, defamation, or invasion of privacy. Liability insurance versus cyber insurance. Cyber insurance and cyber liability insurance are terms often used interchangeably, but they can refer to different types of coverage depending on the context. Cyber insurance is a broad term that generally refers to a range of coverages designed to protect businesses from various technology-related risks. It can include both first-party and third-party coverages. First-party coverage insures against financial losses the insured organization incurs directly due to a cyber incident, such as business interruption losses, data recovery costs, and ransom payments. Third-party coverage refers to liability coverage for claims made against the insured organization due to a cyber incident, such as lawsuits related to data breaches. On the other hand, cyber liability insurance is often used to specifically refer to the third-party liability coverage part of a cyber insurance policy. It covers the insured organization's liability for damages resulting from a data breach or loss of sensitive information. This can include costs related to legal defense, settlements, and judgments, as well as regulatory fines and penalties. Both types of policies aim to mitigate the financial impact of cyber events, but the specific coverages can vary widely between insurers and individual policies. Cyber liability insurance policies. Cyber liability insurance policies typically include coverage for third-party claims resulting from cyber incidents. Privacy liability coverage protects against liabilities arising from data breaches that expose private data and violations of privacy law. Network security covers losses due to security breaches, such as unauthorized access, malware, and DDoS attacks. Network business interruption provides coverage for loss of income and extra expenses incurred due to a cyber event that disrupts the business. Media liability covers legal claims due to electronic content, such as copyright infringement, defamation, or invasion of privacy. Errors and omissions (E&O) protects against losses from mistakes in the provided services, particularly for technology and professional services firms. Cyber insurance policies. Cyber insurance policies generally include both first-party and third-party coverages. Typical inclusions are: data destruction covers costs related to the loss or corruption of data. Extortion provides protection against threats to release sensitive information or attack systems unless a ransom is paid. Online theft protects against losses due to unauthorized online transactions. Hacking activities covers damages from hacking, including data breaches and system intrusions. Denial of service includes coverage for losses due to deliberate or accidental denial of service attacks. Criminal reward funds. Some policies may offer funds for information leading to the arrest and conviction of cybercriminals. Current trends in the cyber insurance market. The current trends in the cyber insurance market include: market growth. The cyber insurance market is projected to grow from $16.66 billion in 2023 to $84.62 billion by 2030, with a CAGR of 26.1% during the forecast period. Geographical dominance. North America is expected to dominate the cyber insurance market during the forecast period. Demand increase. There is a strong demand for cyber insurance due to the rising adoption of public cloud services, evolving workspace models, increasing cybersecurity threats, and the need for technological advancements. Market stabilization. After a period of rapid premium increases, the market is beginning to stabilize. This is due to insurers improving their risk evaluation methods, new market entrants providing coverage, and the natural balancing of supply and demand. Stricter underwriting. Insurers are developing stricter requirements for policies, which has led to a decline in the number of insurable companies and an increase in demand. Focus on risk management. Cyber risk management is becoming a core focus in a digitized world, and cyber insurance is seen as an essential part of this. The industry is working towards facilitating a sustainable cyber insurance market. Technological trends impact. Future cyber attacks are expected to be accelerated by key technology trends such as artificial intelligence, the metaverse, and the convergence of IT, IoT, and operational technology, OT, which will create new attack surfaces and systemic risks. Coverage restrictions. Carriers are expected to restrict coverage for systemic risks, and underwriters are continuing to focus on security controls. Price normalization. Price increases for cyber insurance have tailed off in the fourth quarter of 2022, indicating a trend towards price normalization. Increased self-insured retentions. Self-insured retentions continue to increase, which means that insured parties are retaining more risk before insurance coverage kicks in. Primary limit changes. Primary limit decreases, which had been a trend, subsided throughout 2022. Market changes in the past year. The cyber insurance market has undergone significant changes in the past year, from 2023 to 2024. Here are some key changes. Market normalization. After 2 years of price increases, the cyber insurance market is normalizing. Insurance carrier loss ratios are healthier now than they have been in the past few years. Price increases tailed off. Price increases for cyber insurance tailed off in the fourth quarter of 2022. Increased self-insured retentions. Self-insured retentions, which refer to the amount of risk that insured parties retain before insurance coverage kicks in, have continued to increase. Subsiding primary limit decreases. Primary limit decreases, which had been a trend, subsided throughout 2022. Continued focus on security controls. Underwriters continue to focus on security controls, which are measures taken to safeguard digital assets. Market growth. The global cyber insurance market was valued at $13.33 billion in 2022 and is projected to grow from $16.66 billion in 2023 to $84.62 billion by 2030. Stabilization. The market for cyber insurance has begun to stabilize after a surge in ransomware attacks in recent years. Decreased pricing. Cyber insurance pricing continued to decrease in the U.S., declining 6% in the third quarter of 2023. These changes reflect a market that is adapting to the evolving landscape of cyber threats and the increasing importance of digital assets and operations for businesses. Insurance premiums changes in the past year. In the past year, the cyber insurance market has seen several changes in premiums. Increase in direct written premiums. Standalone cybersecurity insurance direct written premiums for 2022 increased by 61.5% from the prior year. Stabilization of prices. The market began to see some correction in 2022 and into 2023, with cyber insurance prices beginning to stabilize. Direct written premiums in the admitted market increased by approximately 50% in 2022, compared to a more than 75% increase in 2021. Decrease in policy growth rate. The number of policies in force decreased by 6.8% in 2021 but increased by 4.4% in 2022. Endorsements and exclusions. Insurers are implementing endorsements around security measures to limit their exposures and tightening policy language, restricting coverage by exclusions. Increased accountability for cyber hygiene. Insureds are held more accountable for their cyber hygiene to receive coverage, and the application process has become more complex. Moderation of rate increases. Cyber insurance prices in the United States rose 11% year-over-year on average in the first quarter of 2023, which was a smaller increase compared to the 28% rise in Q4 2022. The rate of increase has been moderating, with an average increase of 17% in December 2022, down from a December 2021 high average increase of 133%. Decrease in pricing. Cyber insurance pricing continued to decrease in the U.S., declining 6% in the third quarter of 2023. These changes indicate a market that is experiencing a shift from rapid premium increases to a more stable and moderated growth in premiums, with insurers becoming more selective and cautious in their underwriting practices. Increased demand. The most common types of cyber attacks that have led to increased demand for cyber insurance in the past year include ransomware attacks. Ransomware attacks have surged, leading to a significant increase in cyber insurance claims. These attacks involve cybercriminals encrypting a victim's data and demanding a ransom for its release. The average ransom demand has also increased, further driving the demand for cyber insurance. Data breaches. Data breaches have continued to be a major concern, with more insurance clients opting for cyber coverage. These breaches involve unauthorized access to sensitive data, which can result in significant financial and reputational damage. Cyber attacks on cyber physical systems. Attacks on cyber-physical systems, which involve the interaction of digital and physical components, have been increasing. The impact of these attacks is estimated to reach over $50 billion, highlighting the growing risk and the need for cyber insurance. Large-scale attacks. Large-scale attacks, such as the Colonial Pipeline ransomware attack, have highlighted the potential for significant disruption and financial loss, increasing the demand for cyber insurance. Insurance premiums by industry. Cyber insurance premiums can vary significantly based on the industry and the size of the company. Industry risk factors. Certain industries are considered higher risk due to the nature of their operations and the data they handle. For example, healthcare, finance, and retail industries often handle sensitive customer data, making them attractive targets for cybercriminals. As a result, companies in these industries may face higher premiums. Company size. Larger companies typically have more complex systems and more data, which can increase their risk profile. Therefore, they may face higher premiums. However, small and mid-size entities with strong cyber controls and in low-risk industries can have average premiums ranging from about $1,400 to about $3,000 per million of limit. Cybersecurity controls. Companies with robust cybersecurity controls and practices may be seen as less risky and could therefore benefit from lower premiums. Conversely, companies without basic cyber hygiene controls may face higher premiums or even struggle to obtain coverage. Claims history. Companies with a history of cyber incidents may be seen as higher risk and face higher premiums. Coverage needs. The specific coverage needs of a company, such as the type and amount of coverage, can also affect the premium. More comprehensive coverage will typically come with higher premiums. Insurance market challenges. The cyber insurance market faced several challenges in the past year. Lack of historical data. The cyber insurance industry has struggled with a lack of historical data, making it difficult to predict future cyber risks and set prices for cyber insurance. High demand. Limited supply. The demand for cyber insurance has been increasing, but limited capacity on the supply side has led to rising rates and adjustments in coverage, terms, and conditions. Risk miscalculation. The cyber insurance market has experienced significant losses due to risk miscalculation, leading to a shift in the market from a soft cycle, characterized by lower premiums and higher limits, to a hard cycle, resulting in skyrocketing insurance premiums. Unsuitable underwriting practices. The market has been characterized by unsuitable underwriting practices, with insurers developing stricter requirements for policies, causing the number of insurable companies to decline and the demand to skyrocket. Systemic cyber risk. The possibility of a large-scale attack where losses are highly correlated across companies makes it difficult to write comprehensive policies. Sector-specific challenges. Specific sectors with historically poor security postures, like education, or highly targeted sectors, like software developers, may have a more challenging time obtaining coverage. Insurance premiums difference. Cyber insurance premiums can vary significantly between industries with high and low cyber risks. For industries with high cyber risks, such as healthcare, finance, and retail, which often handle sensitive customer data, the premiums are typically higher. These industries are attractive targets for cybercriminals, and as a result, they face higher premiums due to the increased risk. On the other hand, industries with low cyber risks, such as those with strong cyber controls, can have average premiums ranging from about $1,400 to about $3,000 per million of limit. In addition, the size of the company also plays a role in the premium costs. Larger companies typically have more complex systems and more data, which can increase their risk profile and therefore, they may face higher premiums. Conversely, smaller entities in low-risk industries with strong cyber controls can have lower premiums. Insurers have also become more selective about who and what gets covered, and have tightened policy terms and conditions to reduce unexpected losses. Several factors are driving the high premiums in the cyber insurance market. Increasing cyber threats. The number and cost of cyber threats are increasing, which in turn increases the value of insurance premiums. As the cost of threats rises, so does the value of the premiums. Rising claims. The frequency and cost of claims have been increasing, leading to higher loss ratios for insurers. This has resulted in higher premiums to cover the increased payouts. Lack of historical data. The cyber insurance market lacks extensive historical data, making it difficult for insurers to accurately predict future risks and set premiums accordingly. Industry-specific risks. The risk and therefore the cost of cyber insurance can vary significantly depending on the industry. Industries with higher cyber risks typically face higher premiums. Business size and nature. The size and nature of a business can also impact premiums. Larger businesses or those with a higher risk profile typically face higher premiums. Geographical location and regulatory environment. The location of a business and the regulatory environment in which it operates can also impact premiums. For example, businesses operating in regions with strict data protection regulations may face higher premiums. Coverage type. The type of coverage a business chooses can also impact premiums. More comprehensive coverage typically comes with higher premiums. Risk management practices. Insurers often consider a company's cybersecurity practices when setting premiums. Companies with robust cybersecurity measures may be rewarded with lower premiums, while those with poor practices may face higher premiums. Insurance-covered attacks. Cyber insurance policies typically cover a range of cyber attacks, and the specific coverage can vary based on the size of the business and the specific risks it faces. Data breaches. This is one of the most common types of cyber attacks covered by cyber insurance. It involves incidents where sensitive, protected, or confidential data has been accessed or disclosed in an unauthorized manner. Cyber extortion. This includes ransomware attacks, where a type of malicious software threatens to publish the victim's data or perpetually block access to it unless a ransom is paid. Network security breaches. This covers incidents where an unauthorized individual gains access to a company's network, potentially leading to data theft or damage. Business interruption. This covers losses that a business may suffer due to a cyber attack that disrupts their normal business operations. Privacy liability. This covers liabilities resulting from privacy law violations or cyber incidents that expose private data. For large corporations, these policies often include coverage for third-party liabilities, such as costs related to disputes or lawsuits, losses related to defamation, and copyright or trademark infringement. For small businesses, the coverage may be more focused on first-party losses, such as costs associated with notifying customers of a breach, paying legal fees, and hiring computer forensics experts to recover compromised data. Businesses often need a combination of both first-party and third-party coverages to be fully protected against the range of cyber risks they face. First-party coverage in cyber insurance policies. First-party coverage in cyber insurance policies is designed to cover the direct costs that a business incurs as a result of a cyber incident. Business interruption. Loss of income and extra expenses incurred due to a cyber event that disrupts the business. Cyber extortion. Coverage for ransom payments made in response to ransomware or other cyber extortion threats. Data recovery. Costs associated with recovering or replacing lost or corrupted data. Notification costs. Expenses for notifying affected individuals, customers, or regulators following a data breach. Credit monitoring services. Costs for credit monitoring services offered to affected individuals after a data breach. Public relations. Expenses related to managing the company's reputation in the aftermath of a cyber incident. Forensic investigation. Fees for experts to determine the cause and extent of the cyber breach. Third-party coverage in cyber insurance policies. Third-party coverage is liability coverage that protects a business against claims made by others, clients, partners, etc., due to a cyber incident for which the business is held responsible. Legal defense costs. Fees for defending against lawsuits related to cyber incidents. Settlements and judgments. Costs of court verdicts or settlements resulting from such lawsuits. Regulatory fines and penalties. Coverage for fines and penalties that may be imposed by regulators following a data breach or cyber incident. Media liability. Protection against claims of intellectual property infringement, defamation, or invasion of privacy due to electronic content. How do first-party and third-party cyber insurance policies differ in terms of premiums? The premiums for first-party and third-party cyber insurance policies can vary based on several factors, and the difference between them is not typically standardized across the industry. For first-party coverage, premiums are often influenced by the type and amount of sensitive data a company holds, its industry, the robustness of its cybersecurity measures, and its history of cyber incidents. The more extensive the potential direct costs, such as business interruption, data recovery, and crisis management, the higher the premium is likely to be. Third-party coverage premiums, on the other hand, are often influenced by the company's exposure to liability risks. This can depend on factors such as the nature of the company's operations, the extent to which it handles or has access to third-party data, and its contractual obligations related to data security. Companies that provide technology services or handle large amounts of third-party data may face higher premiums for third-party coverage. How do first-party and third-party cyber insurance policies differ in terms of deductibles? The deductibles for both first-party and third-party cyber insurance policies can vary based on several factors, including the type and size of the business, the level of cyber risk it faces, and the specific coverages included in the policy. For first-party coverage, the deductible may be influenced by the potential direct costs to the business from a cyber incident, such as business interruption, data recovery, and crisis management costs. A business with a robust cybersecurity infrastructure and a good track record of managing cyber risks may be able to negotiate a lower deductible. For third-party coverage, the deductible may be influenced by the business's exposure to liability risks. Businesses that handle a lot of third-party data or provide technology services may have higher deductibles due to the increased risk of third-party claims. In general, higher deductibles result in lower premiums, and vice versa. Therefore, businesses must balance the desire for lower premiums with the ability to pay a higher deductible in the event of a claim. It's important to note that the specific deductibles can vary widely between insurers and individual policies. Businesses should carefully review the terms of any policy they are considering and discuss their needs and risk tolerance with their insurance broker or agent. Factors affecting premiums for first-party cyber insurance policies. Several factors can affect the premiums for first-party cyber insurance policies. Type and amount of data. Companies that handle large amounts of sensitive data, such as personal information or credit card details, may face higher premiums due to the increased risk of data breaches. Industry. Certain industries, such as healthcare and finance, are often targeted by cybercriminals and may face higher premiums. Cybersecurity measures. Companies with robust cybersecurity measures in place may be able to negotiate lower premiums. Past incidents. Companies with a history of cyber incidents may face higher premiums. Revenue. Larger companies with higher revenues may face higher premiums due to the greater potential financial impact of a cyber incident. Coverage limits and deductibles. Higher coverage limits and lower deductibles typically result in higher premiums. Factors affecting premiums for third-party cyber insurance policies. The premiums for third-party cyber insurance policies can also be influenced by several factors. Type of services provided. Companies that provide services involving access to third-party data or systems may face higher premiums due to the increased liability risk. Contractual obligations. Companies may face higher premiums if they have contractual obligations that increase their liability in the event of a data breach. Industry. As with first-party coverage, certain industries may face higher premiums due to the increased risk of cyber incidents. Past incidents. A history of cyber incidents or claims can result in higher premiums. Coverage limits and deductibles. As with first-party coverage, higher coverage limits and lower deductibles typically result in higher premiums. Insurance exclusions. Cyber insurance policies typically include several exclusions, which are specific situations or circumstances that are not covered by the policy. War and terrorism. Cyber insurance policies typically exclude coverage for losses resulting from acts of war, terrorism, or other hostile actions. Physical damage. If a cyber attack destroys physical infrastructure or equipment, the insurer may not cover the costs of repairing or replacing those assets. Technological improvements. Cyber insurance helps businesses restore their computer systems to the state they were in before the cyber incident. However, the cost of upgrades or improvements to the technology is typically not covered. Unencrypted data. If a data breach involves unencrypted data, the insurer may deny the claim based on this exclusion. To minimize the risk of having a claim denied, businesses should follow industry best practices for data encryption and other security measures. Potential future lost profits and loss of value due to theft of intellectual property. Insurance policies generally do not cover potential future lost profits or the loss of value due to the theft of intellectual property. Industries with high cyber risk. Industries with high cyber risk are typically those that handle sensitive data, have a high degree of digital connectivity, or are critical to infrastructure. Here are some examples. Healthcare. This industry is a prime target due to the sensitive nature of the data it handles, including personal health information and payment details. Cyber attacks can also disrupt critical healthcare services. Financial services. Banks and other financial institutions are attractive targets due to the financial data they handle. They are often targeted for financial gain or to disrupt financial systems. Education. Educational institutions often have large amounts of personal data and research information, making them attractive targets. They also often have less robust cybersecurity measures compared to other sectors. Retail. Retailers handle a large amount of personal and financial data from customers, making them attractive targets for cybercriminals. E-commerce platforms are particularly vulnerable due to their online nature. Public sector. Government agencies are often targeted for the sensitive information they hold, which can include personal data, financial information, and state secrets. These attacks can be motivated by financial gain, espionage, or disruption. Manufacturing. The manufacturing sector is increasingly being targeted due to its high disruption factor and the potential for theft of intellectual property. Automotive. The automotive industry is becoming a target due to the increasing connectivity of vehicles and the potential for large-scale disruptions. Industries with low cyber risk. Low-risk industries might include agriculture. Traditional farming may not be as attractive to cybercriminals due to less reliance on digital technology and fewer valuable digital assets compared to other industries. Construction. While construction companies are increasingly using technology, they may not be as high-value targets as industries like finance or healthcare. Entertainment and media. While these industries do face cyber risks, especially related to intellectual property theft, they may not be as heavily targeted for sensitive personal data as industries like healthcare or financial services. Services, non-financial, service industries that do not handle large volumes of sensitive financial data may face lower cyber risks. It's important to note that no industry is immune to cyber risk, and the level of risk can vary within an industry based on a company's specific practices and exposure. Even within industries that are generally considered to have lower cyber risk, companies that are more digitally connected or that handle any sensitive data may still face significant risks and should take appropriate cybersecurity measures. Industry cyber risks. Healthcare. Data breaches. Healthcare organizations hold large amounts of sensitive data, making them prime targets for data breaches. Ransomware. Cybercriminals target healthcare to cause disruptions and extort money by encrypting patient data and demanding ransom. Financial services. Data theft. Financial institutions are targeted for the financial data they handle, which can be used for fraud or sold on the dark web. System disruption. Attacks aimed at disrupting financial systems can have widespread economic impacts. Education. Data breaches. Educational institutions hold valuable research data and personal information of students and staff, which can be targeted. Ransomware. Schools and universities are increasingly victims of ransomware attacks, disrupting operations and accessing sensitive data. Retail. Payment card fraud. Retailers process large volumes of payment transactions, making them targets for cybercriminals looking to steal credit card information. E-commerce attacks. Online retail platforms are susceptible to various cyber attacks, including data breaches and denial of service attacks. Public sector. Espionage. Government data is often stolen for espionage purposes. Financial gain. Public administration is targeted for financial gain through various cyber attacks. Manufacturing. Intellectual property theft. Manufacturing companies are targeted by hackers who want to steal intellectual property such as product designs and blueprints. Operational disruption. Cyber attacks can cause physical damage to products or machines, leading to operational disruptions. Automotive. Connected vehicle attacks. As vehicles become more connected, they are at risk of cyber attacks that could compromise vehicle functionality and safety. Theft of intellectual property. Automotive companies may face cyber risks related to the theft of design and manufacturing data. Agriculture. Data theft. As farming becomes more digital, data related to crop yields, livestock health, and machinery performance can be targeted. Operational disruption. Cyber attacks on agricultural technology could disrupt farming operations. Construction. Data breaches. Construction companies often handle sensitive project data, which can be targeted by cyber criminals. Operational disruption. Cyber attacks on construction technology could disrupt project timelines and cause financial loss. Entertainment and media. Intellectual property theft. Entertainment and media companies often hold valuable intellectual property, which can be targeted by cyber criminals. Data breaches. These companies often handle personal data of customers, which can be targeted. Services. Non-financial. Data breaches. Service companies often handle personal data of customers, which can be targeted. Financial fraud. Cybercriminals may target these companies for financial gain, such as through fraudulent transactions. Predictions for the future of the cyber insurance market. The future of the cyber insurance market is expected to see significant growth, driven by the increasing frequency and cost of cyber threats. Market growth. The global cyber insurance market is projected to grow significantly. According to Fortune Business Insights, the market was valued at $13.33 billion in 2022 and is forecast to grow to $84.62 billion by 2030, exhibiting a CAGR of 26.1% during the forecast period. Increasing demand. Demand for cyber insurance has been increasing, but limited capacity on the supply side has led to adjustments in coverage, terms, and conditions. This demand is likely to continue to grow as cyber threats increase. Dynamic underwriting. As cyber risk management and risk quantification become increasingly popular, the shift to dynamic underwriting will become more feasible. This involves insurers adjusting premiums based on a company's current cybersecurity posture and practices, rather than static factors. Stricter requirements. Insurers are developing stricter requirements for policies, which could lead to a decrease in the number of insurable companies but an increase in the demand for cyber insurance. Data-driven policies. The use of data to drive policy underwriting is expected to increase. This could lead to more accurately priced premiums, lower loss ratios, and higher profitability for the insurance industry. Increased collaboration. Insurers and vendors are expected to work together more closely to develop sustainable solutions for the cyber insurance market. This could involve increased communication to prevent attacks. Growth factors. Several key factors are driving the growth of the cyber insurance market. Increasing cyber threats. The rise in cyber attacks and data breaches has led to an increased awareness of the risks and the need for protection, driving demand for cyber insurance. Growing awareness. More businesses are understanding the need for cyber insurance as they become more aware of the potential financial and reputational damage that can result from cyber threats. Regulatory environment. The regulatory environment is also driving growth. As data protection regulations become stricter, businesses are increasingly seeking cyber insurance to help manage their regulatory risk. Digital transformation. The shift in business models towards more digital and e-commerce capabilities has increased the exposure to cyber threats, driving the demand for cyber insurance. Data-driven policies. The use of data to drive policy underwriting is becoming more prevalent. This allows cyber insurance companies to offer more accurately priced premiums, which can lead to lower loss ratios and higher profitability for the industry, thereby driving growth. Limited supply. Demand for cyber insurance has been increasing, but limited capacity on the supply side has led to adjustments in coverage, terms, and conditions, which has contributed to market growth. Risk awareness and preparedness. Increased awareness of cyber risks among businesses and the recognition of the need to protect themselves against these risks are contributing to market growth. Advancements in underwriting and risk assessment models. Insurers are working to better understand and quantify cyber risks, which is helping to fuel market growth. Emerging technologies are expected to shape the future of cyber insurance in several ways. Artificial intelligence and the metaverse. Future cyber attacks will be increasingly influenced by key technology trends such as artificial intelligence and the so-called metaverse. Internet of Things, IoT, and operational technology, OT. The expanding worlds of IoT and OT offer great opportunities but also create new attack surfaces, vulnerabilities, and systemic risks. Crypto insurance services. The rising adoption of crypto insurance services is expected to drive market expansion, reflecting the increasing digitization of financial services. Adapting to the changing cyber landscape. Insurance companies are adapting to the changing cyber landscape through several strategies. Stricter underwriting practices. Insurers are requiring more detailed information about IT systems and security controls from businesses seeking coverage. This helps them better assess the risk and tailor the policies accordingly. Higher deductibles and coverage restrictions. To manage their risk exposure, insurers are increasing deductibles and placing restrictions on coverage, particularly for systemic risks and technology errors and omissions. Emphasis on proactive risk management. Insurers are placing more emphasis on proactive risk management, encouraging businesses to engage in comprehensive risk management practices, including partnering with third-party security providers to identify and mitigate vulnerabilities. Collaboration with cybersecurity firms. Insurers are collaborating with cybersecurity firms to develop comprehensive insurance products that reflect a better understanding of the risks involved. Investment in cybersecurity measures. Insurers are investing in robust cybersecurity measures, regularly updating their systems, and providing comprehensive training to employees to identify and respond to potential threats. Tailoring insurance products. Insurers are tailoring their insurance products to meet the individual needs of clients, recognizing that different businesses have different concerns and risk profiles. Building partnerships beyond the insurance industry. Insurers are working with government agencies, academic institutions, and industry associations to navigate emerging risks and develop a more comprehensive understanding of the cyber threat landscape. Adjusting to market volatility. Experienced insurers are using their historical knowledge to navigate market fluctuations and provide stable, effective solutions for clients. Insurance benefits. Cyber insurance offers several benefits for businesses. Coverage for data breaches. Cyber insurance can cover the costs associated with data breaches, including litigation, recovery, and identity theft. This is particularly beneficial given that a cyber attack, on average, can cost a company over $1 million. Reimbursement for business loss. Cyber attacks often interrupt business and cause lost revenue. An effective cyber insurance policy can insulate a company from these costs. Defense against cyber extortion. Cyber insurance can provide coverage against cyber extortion, such as ransomware attacks, where critical business data is encrypted and held hostage by cybercriminals until the company pays. Coverage for business interruption losses. Cyber insurance can cover business interruption losses, keeping businesses financially afloat while recovery efforts are underway. Regulatory compliance. Cyber insurance can help cover potential fines and the cost of legal defense associated with non-compliance to data protection regulations. Reputation management. If customer information is hacked or data is held hostage, it can significantly damage an organization's reputation. Cyber insurance often provides crisis management and public relations support to manage such situations. Risk mitigation and recovery resources. Cyber insurance provides resources for risk mitigation and recovery, helping businesses respond quickly and effectively to cyber incidents. Limited financial liability. Cyber insurance limits the financial liability of a business in the event of an attack, providing financial compensation to respond. Peace of mind. cyber insurance provides peace of mind that businesses have taken action to ensure their financial stability in the event of a cyber incident. Competitive differentiation. Having cyber insurance can provide a competitive edge, demonstrating a business's commitment to managing cyber risks.